welcome to the Horner and Roberts video, FATCA, the latest interpretations and rulings. We were pleased to partner with Ross McGill, CEO of T-Consult on this. As with all live presentations, there is a little bit of background noise, so apologies for that. And we also had a slight problem with the recording where it cuts Ross off right at the end of his presentation. But we hope you enjoy.
So let me just tell you a little bit about where FATCA is today, where it might be tomorrow, and if you've got any questions. There are no such things as dumb questions for me. So the very first one, I just love this. I found it, created it, I use it in all my presentations, which is unfortunate because in Scandinavia they don't know who Humphrey Bogart is. So they're all looking at the screen going, oh, we don't know what you're talking about. Okay. And this concept of a gin. Okay, lots of people talking about gins, and there are currently about 101,000 gins that have been issued around the world to non-US financial institutions. I'll talk a little bit about that later on. One of the things you need to understand here is that regulators write crap regulations. Lawyers write crap laws, especially in America. And the net result is we end up with things like FATCA, which are almost inoperable. The GIN system, which is a global intermediary identification number, is supposed to be the big database in the sky that allows the US to understand all about every foreign financial institution. There's the first point, is you don't think you're foreign. You think you're you. And when you get out as far as places like Asia, and you talk about them as being foreign, they look at you as if you are foreign. And so there's a language problem. The regulations are written in tax technical American. Very few people speak tax technical American, and I include the IRS in some of that as well. But the challenges that FATCA brings, and that's on the next slide, and I'm only going to talk about 4 of them. There are many, many more. But the challenges that FATCA is bringing today are basically confusion. I don't know who I am, what I'm supposed to do, and I don't know when I'm supposed to do it. That's the kind of conversation I've just had over the last 2 or 3 hours. And a lot of that has to do with the way in which the regulations were written. At base, the Americans are trying to find Americans who are evading tax. So when people start talking to you about things like FATCA withholding, anybody heard that term yet? FATCA withholding? You've got to remember, FATCA withholding is just a penalty. Okay? It's a penalty that's designed to try and make you disclose any Americans that you have. The penalty that's really in the regulations is that when you all start reporting to the IRS, of course, in the UK, we have an intergovernmental agreement, because if anybody tried to report clients from a UK financial institution to the Americans, you'd be breaching data protection directives in the European Union. And so, to get around that, the US and the European Union agreed on intergovernmental agreements. UK has signed one, so have many others. And the principle of that is really just to get you guys off the hook. Because now it means you still have to report any US account holders. But you do that to your domestic regulator, and they then use what's another set of regulation, which is the Automatic Exchange of Information Agreements, and the IGAs, to pull that information directly from the UK regulator. So you're off the hook for data protection, and they just send the data anyway. So it ends up in the same place. What happens then? What happens then is the American government will look at that list of Americans that you've reported. And now they're going to look to see if those Americans disclosed their non-US bank accounts and the assets and the income that they got from it. Why? Because the Americans' system claims the right to tax the global income of its citizens. And so if an American has an account in Singapore and gets a dividend from a Belgian company paid through a French bank, they're supposed to declare that on their US tax return and pay tax on it. So you can imagine, the big penalty in FATCA isn't FATCA withholding. That's just a big stick to beat you about the head with to try and make sure that you comply with the regulations. The regulations are all about customer due diligence, identify Americans, and report them to the IRS. Because the IRS wants the tax. And it can go back 6 years. So when it finds someone that's reported by a non-US financial institution, it's going to look at that income and it's going to want that person to pay the tax that's due on it. The problem is that the language that's out there is almost incomprehensible. And I'll talk a little bit about that in a little while. The other piece that I want to talk about is the rate at which adoption is taking place. And that's quite good fun because on the one hand, you've got, I'll call them activists, for want of a better word. And some of the activists include people in the Republican Party in the United States. And Senator Levin inside the United States wrote an article and published it on the internet, helping Americans to evade FATCA. He told them how to do it. You know, in FATCA, and again, I'm assuming a level of knowledge, if you're an institution outside the US, you have an obligation to figure out whether your client is an American. But they only want you to do additional due diligence if the value of the account that person holds is over a certain threshold. They're trying to be good to us by saying, you know, don't bother with somebody who's got $5 in their account. If they've got $1 million in $5, now that's serious tax. Well, the issue there is that you've got financial institutions trying to figure out whether they've got Americans and building up a report to send over to the IRS. It's a horrendous situation. All that was told by Senator Levin in his article was, well, am I being dumb here, but I'll just open up 5 accounts with 5 different institutions. And I'll put $900,000 in each of the 5 institutions. That gets around FATCA straight away. Why? Because under FATCA, if you are in an institution, you have an obligation to look at all the accounts. So if Ross McGill has got 5 accounts with HSBC, as an example, HSBC has an obligation to take all of the accounts and add their values up to see whether it triggers past $1 million. If it does, now they have to ask me more questions. Where were your parents born? Do you have substantial presence in the United States? That means, have I been in the United States for more than 183 days over the last 3 years? Simplified calculation. Yeah. Was either of my parents born in the United States? Winston Churchill was an American under FATCA. Boris Johnson is an American under FATCA. Yeah. Winston Churchill because one of his parents was born in the United States. So the issue is not actually the Americans who know they're Americans as account holders. That's not the problem. The problem are the people who have high-value accounts who will swear blind that they are not Americans because they don't understand what the different rules are. And if they have high-value accounts, it's your job as financial institutions to ask those questions of that higher echelon. So there are lots of ways and lots of flaws in FATCA. So the first point I would make is don't assume that FATCA is flawless. It's full of holes. And so Americans will continue evading tax. The way in which the US government is trying to make this happen, of course, is by getting foreign financial institutions to sign up. Okay? And there are different ways of signing up. One way is called certification. You hand a document to your financial institution and you say, this is who I am. As a financial institution, the other way is you register at the IRS website. And when you register at the IRS website, you are either signing an agreement electronically, which is called an FFI agreement, or you are telling them, we've done all of our homework, we know how to document our clients, and we know which ones are American, and therefore we are deemed compliant. Okay? And the lexicon, the dictionary of what people can be in this set of regulations is truly incomprehensible. The third thing I want to talk about is what's called most favoured nation status. You all deal with regulation every day of the week. The US has signed lots of intergovernmental agreements, and that's great, because the object of those IGAs is to try and simplify FATCA for you. Yes, it makes all sorts of assumptions and says, because you're in the UK, because we like you you English people, we're going to make it easy for you. So certain types of entity are compliant, you don't have to report on them, there's no tax to withhold, they make it easy. The problem is that there are lots of these IGAs all around the world. And in every single one of them, there's a clause called Most Favoured Nation. And what that means is that the IRS, in their infinite wisdom, have said to people, Alex, I'm going to agree something with you, and here it is, it's a 10-page document, but by the way, if I agree anything with any of these other 70-odd people here, you get the benefit of what I agree with them. So if it's more favourable, yeah, you, sir, are a really hard negotiator, and you extract from me a benefit. I'm not going to have to write to you, and I'm going to tell you that the agreement I have with you has to be changed, because I agreed something better with him, and you have most favoured nation status, and vice versa. So when you thought you were trying to organise systems, procedures, operational compliance, tax, legal, you thought you were just looking at an IGA and it was making life simple. No, it doesn't. And that's started happening already because the US has just written to 17 countries to say that because they negotiated a better term in, I'll be technical here, Article 7 of their IGA, they've now had to amend 17 other IGAs, including the United Kingdom. And that happened last week. And so now everybody's got to go and say, well, so what was it that changed? Was it good for us or bad for us? What systems need to change? Do we need to change policies, procedures? So you can imagine now it's going to be a cat's cradle of complexity. The final thing I want to talk about, and at this rate I will talk about them before I've actually got to them, is deemed compliance. I mentioned that before. There are lots of ways in which the Americans have said, if you fit a certain model, you don't have any impact of FATCA. It used to be called a carve-out. Pension funds wanted to be carved out. What they did was they changed that term to being deemed compliance. Now, the problem with deemed compliance is that it's variable, not fixed. So, for an example, in FATCA, there's a concept called NFFE. Did we know what that means? Right. Non-financial foreign entity. In other words, it's a customer that's a corporation. Okay? There are two types of NFFE, active and passive. Okay? An active NFFE is one that makes widgets. Yes, it's a corporation and it's got a business. A passive NFFE is a corporation which generates more than 50% of its income from investments. Okay? So, for example, if you've got a manufacturer of widgets, and they're really successful at making widgets, and they build up a massive cash balance, the CFO will take that cash balance and invest it in stock markets. And so they start getting dividends, and they pile up the dividends. Well, as long as the dividends that are coming in and the investment revenue that's coming in isn't more than 50% of the overall money they get from making widgets, then they're an active NFFE. Otherwise, they're passive. But the problem here is that that passive status isn't fixed. You have to look at it every year. So this year, you might be an active NFFE. You've built up massive cash, you've invested it. And next year, nobody wants to buy widgets. Your sales drop, your gross revenue drops, but you're still getting dividends from the marketplace, and now your passive income exceeds your widget-making income. Somebody has to figure that out, because that's a material change. And now, I have to go back to my bank and say, I gave you a form, a certification of tax residency for FATCA, and last year I was an active NFFE. This year I'm a passive NFFE. And then they're going to say, great, now I need to know, I need tax residency certificates from all of your directors and shareholders. So you can see that some of the things that make up FATCA are not as easy as they sound. So let's whiz through this, because I've got 30 minutes. I can't remember what time to start.
About 17 minutes ago.
Okay, right. I've got half time left. So very quickly through some of these. So concepts you need to know. I have to tell you, I could have written 5 pages like this. Okay? Foreign financial institution. You may think that sounds pretty logical. The problem is that FATCA redefines a financial institution. So what you think of today as a typical financial institution might be a brokerage firm, a custodian bank, a normal depository bank or a depository bank, CSD. That's fine. Pension fund's also a financial institution. A collective investment vehicle is also a financial institution. So the problem is that a lot of these firms that didn't think of themselves as financial institutions now fall under that definition. And they have no resource pointed at this kind of stuff and no understanding of how the financial institutions, the traditional ones, work and how you integrate the two. I've talked about NFFEs. There are all sorts of other technical terms. I could have talked about registered, deemed compliant, non-reporting IGA FFIs. I'm not going to, because I was talking to one earlier this afternoon. But the terminology becomes so difficult. Consider this. If you think it's hard understanding this, how do you think they think about it in China, in Hong Kong, and in Singapore, and in Taiwan, in places where the back office personnel may have English as a second language, where the cultural imperative on compliance is a lot lower than it is in Western Europe. So you've got the language barrier, the cultural barrier, and you start talking about expanded affiliate groups, intergovernmental agreements. What's the difference between reason to know and actual knowledge? Do you really know the difference between reason to know and actual knowledge? No? Man walks into a bar. I love this one. Man walks into a bar. He's a relationship manager. He happens to meet his client at the bar. And the client is complaining about how often he has to go to the United States for business. And, you know, he takes a 4-week holiday there, and he's over there for business, 3 months. And he's been doing that for 5 years. You now have reason to know that whatever your KYC rules say, whatever he said he was when he opened the account, you now have reason to know that that's in America, under FATCA. You haven't seen any documents, but you've got reason to know because your customers told you something. Okay? Actual knowledge is when he goes, something, I ended up getting a couple of passports, and he holds the passports up, and one of them's an American passport. So, I hate the queues at JFK, and so I've got an American passport. Now you have actual knowledge, because you've seen a document that proves it, even though he may have told you when you opened the account that he's not American. All of those go into the most important part of FATCA, which biggest challenge is called customer due diligence. Because there are different rules for accounts that have already been opened, and different rules for accounts that are yet to be opened. And within each of those, it's layered so that the due diligence is based at the lowest level just on KYC, and then on the aggregated value of the accounts, which triggers additional due diligence, where you're supposed to ask the questions. You're supposed to go and look at all the paper records. Some of the rules say you can just do electronic searches. But you have to know what the value of the account is to know what kind of due diligence to do. So it's not as easy as it looks. I talked about responsible officer this afternoon to my other client. And I've just appointed a responsible officer. And he said, so I've actually put the name on the thing. I drew the short straw. I said, good. Have you figured out what that means yet? He said, well, I know it means I'm going to make sure everything's compliant. I said, you do realise that when your name goes onto a W8IMY and it goes to another financial institution, it's a personal certification you're making, not a corporate one. And the certification means that there's a penalty if you make an incorrect statement on that form of $250,000 fine, 3 years in jail, or both, in America. So a responsible officer is responsible. And there's a whole pile of stuff that they're supposed to do. And yet, when I talk to people, they go, oh, the Americans want a responsible officer. Who's going to sign the W8IMY? Oh, Janice from accounts, great. Sign this, we'll send it on. I oversimplify it, but there are a lot of areas here where there are significant risks for financial institutions, and it all starts with knowing the language. On the next slide, I just wanted to talk a little bit about IGAs. The object of the IGAs, as I've said, is to try and simplify FATCA. It does two things. It basically says lots of things are out of scope of FATCA within certain jurisdictions because America trusts them. Okay? Not. But they've come to an agreement about what's in scope and what's out of scope. It also means that a couple of the really nasty penalties that exist everywhere else don't exist in IGAs, in IGA countries. If you have a client and you ask them to fill a form in and they refuse, or they don't provide you the information you ask for in order to determine what their FATCA status is, the regulations say that that customer is now recalcitrant and you must withhold 30%. Okay? There are only two types of account holder that can be recalcitrant. They are individuals and NFFEs. I come across the misunderstanding all the time. I've got a recalcitrant FFI. No, you haven't. You can't have a recalcitrant FFI. Doesn't make any sense. Yeah? You can have recalcitrant individuals and you can have recalcitrant NFFEs. FFIs are either participating or non-participating. Participating, you're okay. Non-participating, 30% or close the account. And that's why you've got IGAs in place. So in a non-IGA market, you've got full FATCA penalties. Non-participating FFIs, the IRS is trying to make sure they just don't exist. And already, I know that some of the bulge bracket financial institutions, their policy is, we will not allow a non-participating FFI to have an account with us, period. So they're all starting to push out and ask for the FATCA status of their financial institution clients. Okay? The question is, how successful are the IGAs at generating this big sign-up that the IRS wants? Well, FATCA is called Chapter 4, okay, of the Internal Revenue Code in the US. There is a Chapter 3, which came into force in 2001, and that's all about qualified intermediaries and, by definition, non-qualified intermediaries. In 13 years, there are only 6,500 QIs in the world today, out of a population of financial institutions who are eligible of about 50,000. So 6,500 out of 50,000. They could have just tried fixing that instead of putting FATCA in place, but they didn't. They put FATCA in place. And so what you've got here in this diagram is essentially a map made last week which shows which jurisdictions have generated the most GINs. Okay? So the only place you can have a GIN is in a market that has an IGA. Okay? So you'll notice that the largest single jurisdiction that has financial institutions that sign up is Cayman. Totally unsurprising that Cayman may be thought of as being a jurisdiction in which Americans might want to evade tax. Okay? But you can see a couple of things. The UK is pretty big, Switzerland is pretty big. I've also highlighted places like BVI, Singapore, Netherlands, Bermuda, Austria, France, Germany and Hong Kong. The thing you'll notice though is, in Cayman, you've got 20,000 financial institutions who have applied for and got GINs. They're very keen to be compliant. The consequence of having the GIN though is that all of those 20,000 are agreeing to disclose any American customer to the IRS. Yeah, so you need to remember what the consequence of these numbers is. But the fact is, the rest of the world is down in the 1 and 2,000 mark. So you have to question whether this thing has got enough critical mass to succeed. Next slide really just tries to simplify. I'm still talking about intergovernmental agreements. trying to reduce the impact of FATCA, make life much more simple. There are 234 tax jurisdictions in the world. Of those, there are 38 which have signed an agreement with the IRS called an M1, and 5 that have signed an M2. So just to make life complicated for you, if there's an intergovernmental agreement, there are 2 types, Model 1 and Model 2. Actually, there are 4 types, because there are 2 subtypes to Model 1 and 2 subtypes to Model 2. And so you can't assume that you can just pick up an IGA and they're all going to be the same. They can all be different. So of the total number of tax jurisdictions, only 18% have actually signed IGAs with the United States. They were so afraid in the US that that number wasn't large enough to create that critical mass that they had to get a bigger number into the market. So they came up with the idea of in substance, which basically means that there are other countries which haven't actually physically signed the IGA, so it's not a done deal, but the Americans wanted to try and bring that number in. So they've said, for the purposes of FATCA, we will allow financial institutions in other markets where there is no IGA to pretend that there is. Okay? And those are called in substance. And there are 50 M1s and 8 M2s, which is another 22%. So you've got what? 40% of all the jurisdictions are actually either signed into IGAs or in substance. Now that's a number. Now you get into critical mass to make this work. Very brief one on how IGAs interact with regulation, because it's one of the most common misconceptions. FATCA started out as the HIRE Act, the Hiring Incentives to Restore Employment Act, passed in the US in 2010. I'm OCD about this. There is no such thing as FATCA. Okay? Foreign Account Tax Compliance Act. There is no act on the US statute books called that. There is the HIRE Act, that's the law. What comes below the law is FATCA, okay, is the regulation. Below the regulation become the IGAs. And so when you're trying to become compliant, especially if you're in a financial group that has many subsidiaries around the world, you've got to know what kind of jurisdiction you're in, and if you're not sure, if there's a differential, you have to go back up to the HIRE Act, or at least to the regulation. A lot of people will basically go, the IGA is silent on this, so I don't need to do it. Wrong. The IGA may be silent on an issue, but the regulation won't be. Yeah? So you need to look at both. And all the IGAs do is 4 things. Okay? So the IGAs modify regulation. Regulation is the base point. Okay? So the first piece is it creates this idea of most favoured nation. It also allows alternate definitions for financial institutions and other kinds of entity. So for example, and I'm making it up, in Spain, pension funds might be called something different than they're called in the United Kingdom. There may be differences in structures. Partnerships may be different. Trusts may be different than they are in the United States. And so the IGAs start to look at each market and create the definitions which parallel what the Americans wanted in their own dictionary. You've got to remember, what the US does, it thinks of a trust as being a grantor trust, a simple trust, or a complex trust. And it has definitions. But that's not necessarily how trusts are structured outside the US. Same for partnerships. And so the IGAs are where that clarification takes place. Coordination of reporting and exchange of information, that's also how the regulation gets modified in the IGA. And the IGA also starts to tell you if there are any differences between how the regulation says you're supposed to document customers and how the IRS allows you to document your customers in your market because of the IGA. Okay? Are you staying with me so far? You're all still sitting up. Okay. For information, the graph on the next page shows GIN rates. Okay? The door opened on July the 1st, and there were just under 90,000 GINs. Those include branches. Okay? So an FFI with 10 branches and 1 head office would have 11 gyms. Okay? And you can see the rate went up to August and is starting to flatten out in September. It's important because that's what's creating this roll effect, the snowball effect. And as the financial industry starts to get a grip on what FATCA means, it means the US is getting consistent adoption of the regulations. On the next slide, really just for reference, I use this one a lot in training courses that I run. And simply, it allows you to understand what you might be faced with in certain circumstances. Most firms I can go, well, these ones don't apply to you, these ones don't apply to you. In a total world, you might have a US withholding agent at the top, and you're outside the United States, so you're a participating FFI. You only have 3 kinds of customer. You have individuals, you have NFFEs, and you have FFIs. Really simple at that level. Okay? All of your individual customers are either going to be US or non-US. The definitively non-US ones are not going to be a problem. The definitively US ones are not going to be a problem, because all that's going to happen is you're going to report their accounts to the IRS, directly or indirectly. The ones that are the problems are the ones that say they're non-US, but don't realise that actually they are US. And there are 6 tests that they have to do to figure that out. NFFEs, we've already covered. There are 2 types, passive and active. So you've got a corporation as a customer. When you receive a certification from them, you have a job to do. You have to validate what they send you. You're not allowed to advise them. They have to tell you what they are. But if they say something on that form, like they're passive or they're active, that is different from your KYC records, you can't accept the form. So this act of becoming FATCA compliant isn't just a one-time deal. You have customer outreach that needs to happen. If your customer is a foreign financial institution, so it's another FI, then you've got 4 different things that they could be. They could be participating, but they're not in an IGA market. They could be non-participating. Most people are just shutting them down. They could be deemed compliant, but there are 2 types of deemed compliance, registered and certified. We talked about those earlier. Or they could be a participating FFI, and they are in an IGA market. So before anybody gets any further, there's a mapping exercise that everybody has to do on what their business looks like in order to figure out what systems and policies and procedures they need to look at. The problem is, and it's very well identified under the registered and certified deemed compliance, because I often get people who come along and say, I'm deemed compliant. I go, good for you. Are you registered or certified? And blank look. Fine. So you may think you're deemed compliant, but you don't know which. And if you looked at, let's see, qualified investment vehicles, QIVs, okay? So if you're a qualified investment vehicle, the key here is you can't be certified deemed compliant, okay? You can only be registered deemed compliant. So there's the first filter. Okay, so people often also say to me, well, I'm not quite sure yet whether we're going to be registered or certified deemed compliant. You don't get the choice. You either fit in the bucket or you don't fit in the bucket. Okay? So it's not a choice, it's a definitional thing. But when you look at something like QIV, there are a series of criteria that allow you to be registered deemed compliant. It's not, oh, I'm a qualified investment vehicle, therefore I will register and I'm deemed compliant. No, you have to go and look at all the criteria. If you are not meeting one of those criteria, even though you're a qualified investment vehicle, you can't be registered deemed compliant. So it's not as simple as just ticking the box. Your problem is, how do you know whether your customer understood all of that? Okay? And if they did, what procedures have they got in place to measure whether they continue to meet that criteria year on year? Because if they don't, that's called a material change. And if you don't know about it, your responsible officer could be hit with a $250,000 fine, or 3 years in jail, or both. You see how everything joins together. Okay? So the variability of deemed compliance status is a big issue. The last thing I wanted to talk about, really, I've already mentioned, which is, and if you think that was complicated, the most favoured nation stuff just makes it explode. And Model 1 IGA system, I have a diagram for each of these things, but the Model 1 system is, if you're a participating FFI, you're going to file your reports to your domestic regulator, and the domestic regulator is going to share that information with the IRS under an automatic exchange of information agreement. But each one of these IGAs has the clause of most favoured nation. And because of something they agreed with Mexico, and I must admit, I haven't read the detail yet, but I know it's in Article 7 of the IGA, and they've done something with Mexico which means that what they've agreed with Mexico is a better deal than they have done with all of the other